Hey everyone, in this video, I'm going to bring you one dividend stock that's yielding 6.5% that passive income investors can buy in 2024. I'm also going to talk about why I like this dividend stock and the reasons I'm recommending it. And it's not just because of the dividend yield. It's not just because of that. So let's get right into it. Let's see what this dividend stock is and why I like it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, AT&T is the dividend stock that I am discussing in this video. And like I mentioned, it's offering investors a 6.47 or 6.5% dividend yield. But like I also mentioned, the dividend yield is not the only reason why I like AT&T stock. In fact, the dividend yield is never the only reason why I invest or consider investing or recommend a dividend stock. It's only one factor. In fact, it's a relatively small factor in my overall recommendation of a stock, the dividend yield. I'm going to share with you the factors that play a more crucial role in my recommending a dividend stock. One of those factors is the operating profit margin. This profit margin takes into consideration a company's revenue and all of its operating costs. These are things like cost of goods sold, sales and marketing, general and administrative expenses, all of the things that it takes to serve a customer. And after all of those costs, AT&T is still profiting 20% in operating profitability. That's a solid profit margin for any company, but I especially like this kind of profit margin for a company at this large a scale and with this type of customer, this type of business. If you don't already know, AT&T is in the wireless and telecom business, which is incredibly sticky. More than 99% of AT&T's customers renew their contract. Renew, right? They keep paying, they don't cancel, they don't switch over 99%. Why is that the case? Well, the business that they've built makes it very high inconvenience for customers to switch. That's called the high cost of switching. That's a desirable characteristic I look for in any business. The opposite is undesirable. If I'm investing in a business, I don't want those businesses' customers to be able to switch in a moment, right? Because I want those customers to stick around, and the harder it is for the customer to switch to a rival, the more likely it is that customer is going to stick around, and the more likely these profits will be sustainable long term, which is especially attractive for dividend stock investors because that leads to greater dividend payouts over time. So this is a primary factor why I like AT&T stock and why I'm recommending AT&T stock in this video. Additionally, AT&T generates significant cash flow from operations. In the trailing 12 months, AT&T generated $37.25 billion in cash flow from operations. That's a lot of cash flow. And for dividend stock investors, that's important because this is where the dividend payment comes from earnings and from cash flow. Without sufficient earnings and cash flow, the dividend would be unsustainable. Sure, a company could pay a dividend from its savings or by borrowing, but eventually it will run out of savings and it will exhaust its borrowing capacity, and the dividend will need to be paused or reduced. That's why I prefer companies that generate sufficient profitability. I showed you already AT&T at 20% and sufficient cash flow. 37 billion is certainly sufficient cash flow to support AT&T's dividend payment longer term. One risk I will highlight with AT&T is the debt. AT&T has total long-term debt of $138 billion. But as you can see, management has been working to reduce this debt balance using some of its cash flow to pay down the long-term debt. Management said that their priority is to pay down this debt, but only after paying its dividend. So it will pay the dividend, and then with the cash that's left over, it'll use to pay down some of this debt and reduce the long-term debt balance. Now, it has the option to be flexible. Most of this debt is not coming due in the near term. In fact, I'll link the video where I go into detail discussing AT&T and Verizon's long-term debt, because Verizon, AT&T's main rival, also has a near $140 billion long-term debt balance. And I went into detail analyzing their long-term debt and when that debt is coming due, when the principal amounts come due. And most of the principal amounts don't come due for several years in the future. So that gives AT&T the flexibility to choose which and when to pay down that debt. If it has a certain debt that's coming due that will cost them a elevated level to refinance, then they can pay it off completely because they've got sufficient cash flow to do so. Or if they get favorable terms to refinance that debt, they can choose to refinance instead. They have the flexibility. However, I am noting it as a risk just in case they lose that flexibility. If something were to happen to its operations where suddenly they lose a significant share of their customers, now the business is that much more risky, because when you add losing market share to a company that has massive long-term debt, that risk is multiplied. And so it's something I always highlight when I talk about AT&T stock. According to their price to earnings ratio, the price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that we understand what the price to earnings ratio is and why that's important in determining how expensive a stock is, you can see AT&T stock is not expensive at a forward price to earnings of 6.9. The average stock in the S&P 500 is trading at a forward price to earnings of around 16 to 20. So AT&T is multiples lower than the average stock in the S&P 500. Although I will say AT&T is not expected to grow at a fast rate not a fast rate at all. AT&T is expecting to grow at 1.1% in 2024 and 0.9% in 2025, with earnings per share growing by 1.5% and 1.2% respectively in 2024 and 2025. It's not a fast-growing company. Investors should not expect fast growth from AT&T stock. But as a dividend stock investor, you're probably not looking for those high-flying growth stocks. You're probably looking for stable, long-term, passive income, and that's something that AT&T can provide, which is why I'm recommending it in this video here. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.